Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday, the 10th of September 2015, and we are going to discuss gold demand and supply and price direction. According to the World Gold Council's second quarter report, published in August 2015, gold demand dropped 12% to a six-year low of 914.9 tonnes in a challenging quarter. Despite pockets of strength, demand was down in all sectors. Meanwhile, supply declined by 5% year-on-year. It further added, jewellery demand came under pressure from negative consumer sentiment, while investment was a casualty of directionless prices and stock market gains. In quarter two, jewellery declined by 81.1 tonnes year-on-year, mainly due to weakness in the Indian and Chinese markets. In India, the percentage fall in this quarter was 23% compared to the previous year, and in China it dropped by 5% over the same period. The onset of the festival and wedding season in India in quarter four suggests healthy prospects for jewellery demand for the remainder of the year, with the caveat that this assumes normal monsoon rainfall. On the positive front, gold investors in Europe, in both retail and institutional camps, boosted their demand for bars, coins and ETFs because of the Greek crisis and the possible threat of European contagion. Outside of Europe, however, investors did not seem to view the risks associated with Greece as systemic. Chinese bar and coin demand remained broadly stable, up 6% but from a low base. However, investment demand in India is down to a six-year low, having contracted for a third successive quarter, declining by 30% to 36.5 tonnes. Looking at 2013 and 2014 figures, we can clearly see why gold prices fell yet again, with total gold supply having risen from 4,283 tonnes to 4,402 tonnes, and demand having fallen from 4,283 tonnes to 4,242 tonnes, there is little wonder we have experienced a price decrease. With the Gold Council's figures estimating a 12% decline in the demand for gold and only a 5% fall in the supply, from a fundamental point of view, unless things change dramatically over the next 3 months, 2015 will prove to be yet another year of declining prices. In fact, according to ABN AMRO, they predict that gold will hit $1,000 by the end of this year, and as low as $800 in 2016. Having drifted for about a week, gold futures made a more definitive move on Wednesday, and the direction was down. A strong US Labor Department report, which according to mining.com revealed the number of job openings in America is at a 14-year high, prompted a surge in the dollar as hitherto negative bets on whether the Federal Reserve will increase rates next week became more even. Gold moves inverse to the greenback, and with no inflation against which to hedge, and at a time of weak physical demand, there is not much in the way of good news. Those hoping for a recovery will be looking to the ongoing concern over China to help prop up prices, after the latest data published last night pointed to weakening producer prices and the threat of deflation. If fears of slower Chinese growth prompt a devaluation of the renminbi and a currency war, gold may just recover some of its appeal as a safe haven. Barclays said in a note quoted by the Bullion Desk that even the September decision, if it is a hold on rates as is now widely expected, would only offer limited support given that a slightly later rise is already priced into the market. Even the most dovish analysis suggests that rates will increase either before the end of this year or very early next year, and this will hit non-yielding gold. The value of the US dollar typically follows an inverse relationship with commodities. When the dollar strengthens against other major currencies, the prices of commodities such as gold typically drops. When the dollar weakens, commodities generally move higher. The main reason for this is because most commodities are freely traded in international markets and prices are quoted in US dollars. Foreign buyers will purchase commodities with dollars, so when the value of the dollar drops, they will have more buying power and demand increases. Similarly, when the value of the dollar rises, they have less buying power and commodities become more expensive, muting demand and sending commodity prices lower. The Economic Times of India recently summarised 8 key reasons why gold prices have fallen and may continue to do so. Number 1, likely rate hike in the US. With the US Fed likely to raise rates first time in nearly a decade, the fear of recession in the world's largest economy is easing. Iran nuclear deal has reduced chances of a conflict in the Middle East, and Greece too has avoided default. As geopolitical risks wane, investors are selling gold. Number 2, lower demand from China. The economic boom in China led to huge demand for gold. With the country now facing an economic slowdown, in the first 6 months of 2015, demand has fallen by about 24%, leading to lower prices. Number 3, strengthening dollar. Like crude oil, gold is also priced in dollars. A stronger dollar means lower prices of gold. With the US economy stabilizing, the dollar has strengthened against major currencies. Number 4, low global inflation. Gold is a hedge against inflation. The easy money policy after the 2008 crisis led to fears of high inflation, but inflation stayed low in the US, Japan, and Europe. Investors are now reluctant to buy gold. Number 5, the 5-year feast ends. For gold, it is said that after 15 years of famine, there is a 5-year feast. After the US slipped into a recession in 2008, gold rallied and peaked at $1,900 an ounce level in late 2011. Then the slide began. Analysts are now looking for price support at $1,000, and if that is broken, then at $700. Number 6, no dividend. Gold does not earn any dividend or interest. If US raises rates, interest income from US bonds will also rise, so investors are preparing to move away from gold to bonds. Number 7, central banks buying less. Traditionally, among the largest gold buyers, central banks, especially from emerging countries, are buying less. But they are piling up dollars to counter outflows once the US raises rates. India's forex kitty in gold stands at 5%, down from 7% 5 years ago. Number 8, ETF outflows. With gold prices falling, gold ETFs are facing redemption, which is forcing them to sell the yellow metal. This has pushed gold prices into a vicious cycle. So there we have it. Despite what you are hearing from the pumpers on YouTube and the hype they're creating because dealers are currently running short of coins and bars, gold demand throughout the world is down and is forecast to continue to fall. So those who were expecting a gold to silver ratio correction may indeed have their wish. But rather than silver prices rising, if the so-called experts are correct, it will be the gold price falling that will achieve this. Frankly, we ourselves still favour gold over the short to medium term compared to silver, though we are not major buyers of either at this time. However, should the economic data that we are being fed proves correct, and the world's economies are slowly beginning to grow, which many doubt, then silver will become the better bet. Let's just see what Auntie Janet does next week before any serious moves or commitments are made. We hope you found this video useful and informative. If so, please give it a thumb up, comment, and if you haven't already done so, please subscribe. Also, it would be helpful if you could share this on Twitter and follow us at Illuminati Silv1. Disclaimer. Silver Illuminati owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we're not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.